Passive investing is an investment strategy to maximize your returns by minimizing buying and selling cycles. So the idea here is to buy and hold an investment for long term in order to harvest income without active participation. So stay tuned to find out the benefits of passive investing and what are the different types of passive investors. Let's first try to understand passive investing. So the philosophy here is to have your money work for you than the other way around. Passive investing is really to build long-term wealth gradually. So a passive investment does not require extensive amount of effort from the investor's perspective. It is also known as buy and hold strategy. So passive investing really means buying a security, a business, or an asset and own it for a long term. So passive investors do not really seek to profit from the short-term price fluctuations or market timing. The underlying assumption here of passive investment strategy is that the market posts positive returns over time. So passive investing really attempts to replicate the market performance by constructing well-diversified portfolio of different assets, which if done individually is going to require a lot of extensive research. Now, maintaining a well-diversified portfolio is really important in order for your success as an investor. Now, of course, there are a few ways of investing passively, and we know that real estate is one of the best ways that gives you better opportunities. So some of the examples would be crowdfunding or REITs or remote ownership, syndications, even real estate debt and equity funds. Now, let's dive into some of the pros of passive investing. Number 1, free up your time and avoid headaches. Haven't you heard of the phrase, time is money? Passive investing in real estate really allows you to preserve your valuable time. Passive investing allows one to forego managing tenants and vacancies and maintenance issues and other headaches that come with these investments. Apart from real estate, the same applies for any business. By passing the control of your day-to-day operations to an expert, you can assure the investment is being well looked after while you can free up your valuable time. Number 2, achieve true diversification. Many commercial real estate investments have high acquisition cost, which is anywhere in 7 figures, that may not be accessible to a lot of people. So these opportunities often have several investors that pool in capital together and invest as a group. So investing passively in a group can actually allow you to invest in multiple asset classes in multiple locations with varying investment durations with smaller capital. And in turn, you're able to actually achieve true diversification. Number 3, avoid credit and liability risk. Investing passively allows one to avoid being exposed to credit or liability risk. Now, you do not need to be personally guaranteeing these multi-million-dollar loans, and you're able to avoid the liability that often comes along with owning real estate. Number 4, cash flow. When done correctly, passive investing in real estate really provides a reliable and a predictable stream of cash flow for many years to come. It is very rewarding to receive these consistent distributions from any investment, but it is even more rewarding when your time is not consumed overseeing these investments. Number 5, multiple streams of income. Many passive real estate investments target high rate of return for their investors, and if you invest consistently into different opportunities, this strategy can actually provide you with multiple streams of income for many years to come. Number 6, tax advantages. Investing in real estate comes with a lot of tax benefits. You can deduct several expenses associated with owning an investment property, including your property taxes, your property management fee, mortgage interest, property insurance, even the cost of any ongoing maintenance and repair, and all the marketing costs that goes in finding potential renters. Now, if you sell your property for more than what you paid for, the gains that you realize won't be taxed as earned income. It will be taxed as capital gain, which has a much lower tax rate as compared to income. If you invest in opportunity zones, which are neighborhoods that are in need for investment, you will be paying less in capital gains. Now, there are many other advanced tax strategies that can help you lower your tax bill, so please talk to your tax professional in order to get advice based on your specific case. Now, what are some of the cons of investing passively in real estate? Number one, it is not as profitable as you might think. Active real estate investing can be far more profitable. While it requires a lot of extra work to do something as large as a value add, it can be much more profitable as compared to passive investment. Number two, hands-off approach. When you're investing passively, you often put investment decisions in the hand of others. So if you're investing in a real estate fund, the person who runs the fund will choose all your investments. Likewise, if you are doing a remote ownership, someone else is managing your property in person, and there's always a chance that they could do a poor job with upkeep or management. So you have to do your due diligence thoroughly before you trust your capital in other person's hand. Number three, market fluctuations. Regardless of whether you're managing a property in person or not, there's always a risk that issues can come up. For example, vacancies or depreciating property values that could hurt your underlying profit margin. Investing, even sometimes in low-risk real estate, always carries some sort of risk. For example, whether an investment is really successful largely depends on the state of the market. Now, investors who invest passively are divided into two categories, really based on their income or net worth, asset size, or their governance status or professional experience. So they are divided as accredited investors or non-accredited or sophisticated investors. Now, watch out for my next series of videos explaining each type of these investors in detail.